Good afternoon, everybody. Welcome to the webinar, Managing COVID-19, Risk and Disruption in the Supply Chain and Distribution Sector. Just our general disclaimer, our firm provides the information in this webinar presentation for general guidance only and does not constitute the provision of legal advice, tax advice, accounting services, investment advice, or professional consulting of any kind. The information provided herein should not be used as a substitute for consultation with professional tax, accounting, legal, or other competent advisors. Before making any decision or taking any action, you should consult a professional advisor who has been provided with all pertinent facts relevant to your particular situation. My name is Joshua Chananie. I am a partner at Sachs LLP, and I am the partner in charge of Sachs's manufacturing and distribution practice. I'm happy to be joined by Sandy Vosk, founder and CEO of Advantage Technology Solutions, Bill Schoolman, founder of the Schoolman Inventory Method, and John Cosgrove, founder and president of Atlantic Handling Systems. As we all know, COVID-19 has brought upon challenging times for the manufacturing and distribution industries. There have been issues that have faced the supply chain and the need to move your business more quickly towards e-commerce. If we've learned anything, it's that companies must either evolve or they will perish. We're going to discuss today the state of the industry, technology investments that are worth it, and how to create the necessary cash flow through unlocking potential in your inventory and government loan programs and tax incentives. It's now my honor to turn the program over to Sandy Vosk, who will discuss the impact of COVID-19 to the supply chain and distribution industry. Take it away, Sandy.
Thank you very much, Josh. It's a pleasure to be here today and joined with such a distinguished team. It's a crazy time. In some ways, it feels like we're in the twilight zone. But if there's one, I love this quote, if there's one essential quality that underpins success in a world of stupefying change, it's resilience, the capacity to adapt to radically new circumstances and emerge from a crisis not merely unbroken, but substantially stronger. This quote was written in the Time Inc. article in 2001, soon after 9/11. And I believe it's even more applicable today. That's certainly our objective for this webinar. To be successful today, your company will need to consider new and better ways to meet customer requirements, allocating people and resources quickly, efficiently, and profitably. Next, please. The current state of the industry is, from a supply chain perspective, excess inventory has followed the pandemic curve and has been exponential growth. It was averaging 40 to 60%, perhaps even higher. Seasonal opportunities have been lost, and that creates even additional inventory. Plans for activities in the summer, school supplies, etc. They're going to be even harder to sell. Certain industries obviously have been hit harder than others. The auto industry, for example, retail industry, no doubt, sports, fashion. So these industries that are not selling are resulting in excess inventory being stored in warehouse and distribution centers. Above and beyond, the length of the supply chain has increased. The time for planning and ordering and shipping product. And the costs associated with that have increased as well. The labor challenges that were there before are now even greater. They've been exacerbated by COVID, as well as everything else, 5 to 10 times whatever people were dealing with before. However, having said that, the opportunities to reduce excess inventory may be easier, faster than waiting for government funding. And above and beyond, there are strategies of which we're going to point out in the next few minutes to help you really target those. So in terms of the impact on e-commerce, I truly believe e-commerce was exploding before. So the term I've been using is now it's like a supernova. Whatever term you want to use, whatever was happening, and you see every technology curve like this, it's now exacerbated. And e-commerce is going to continue to grow faster and faster. Why? Because there's a recent DC Velocity article noted, as more people stay home, online ordering and demand for home delivery are increasing, creating order backlogs and putting pressure on delivery methods, in many cases among companies that were just beginning to get a handle on their e-commerce and omni-channel business strategies. So this is just creating more challenge, more stress on the current manufacturing distribution industry. Next. And prior to the pandemic, these were the key issues that were affecting companies. Number one is inventory management. And that's only going to be harder now because of the excess inventory and space capacity issues that companies are experiencing, making it even harder to handle order fulfillment and processing in the time and the price that customers are willing to pay for it. And that doesn't even deal with the returns of a lot of these products. Sometimes 30 to 40% of what's shipped is returned. Order management and amendments therefore become even more complicated because of the impact of the pandemic, as well as manufacturing and production. Everything, whatever was happening before, is now 5 times harder because of the pandemic. Next. Now, the great thing, and certainly from my perspective, is there are amazing growth in technologies equal to the change in e-commerce. And there's an explosion of technologies out there, but which ones are right for you? That's the hardest decision today. And my core belief is you cannot make this decision. Most executives cannot make this decision alone and need to bring in trusted advisors to help them, because there's no one way to do this. It's really understanding what your requirements are, your goals are, and how to maximize the benefits of technology to achieve your objectives. What I will share is that the majority of companies today are still behind the curve in terms of investment and adoption. And according to a modern material handling study last year, believe it or not, nearly half of warehouse and distribution managers say they still use mostly manual processes for order fulfillment. That was not a scalable strategy before. That's not a strategy for survival now. And we need new strategies to stay profitable post-pandemic. Next. So one of the key areas is, not just from a systems perspective, it's not just about systems, it's about material handling equipment, and how do you design a facility for maximum productivity in a post-COVID world. So John, why don't you take it from here?
Thank you, Sandy. I want to thank you for the opportunity here today to speak with my esteemed colleagues about this very important subject for people who are in the warehouse and distribution industry. As Sandy said before, he calls it a supernova, the e-commerce trend. I've been calling it a tidal wave, but together it spells that it has changed things based on the demographics of the people who are now, because of the virus, using e-commerce. A lot of senior citizens and baby boomers were not using e-commerce. They like going into the stores and doing those things, but due to the virus, all of that has changed. So what's changed then on the warehouse side is, what are we going to do to fill these orders, and how are we going to do it? And the next graph, what it shows is that if you look at the fully automated people using fully automated systems, was at 15%, mostly 15, 10%. The big jump, people who partially were automated, and now in blue shows you that there'll be probably a 20% increase in automation in warehouses within the next 6 months. So what's really happening is the people who are in the gray area that are not automated at all, their competitors are going to be almost 2/3 automated and ready to fulfill orders. This is especially important during COVID because it makes social distancing easier. It also makes picking orders easier. One of the things that has happened within warehousing today is that a lot of companies are building a warehouse within a warehouse. They're separating their e-commerce business and building it and automating it and leaving the traditional picking of cases and pallets the way they used to, but they've automated much of the picking, which is of eaches within pick modules and with Conveyor that sorts by all different, we can sort by anything we'd like to do, but mostly, truckers and how we want to ship it. And what's really come down now is that if the faster you can ship it, the quicker your response time, the more business you're going to do and be more profitable. One of the things we've done recently, because all of this new business and all changes within the industry has put space constraints on our customers, is that we've elevated a lot of the automated systems we've done. We've hung them from the roof. We've built mezzanines to free up floor space so that you can have floor space to work and stage orders and to load. Sortation systems are very popular now because you can sort by FedEx, UPS, United States Postal Service, and a lot of the e-commerce business, of course, as we all know, are going that way. Next slide. Distribution centers have to be well organized for inventory and stock up above. If you look at this, this is a warehouse that we just finished where they pick a lot of eaches, does a big e-commerce business. They pick this and then they pick to what we call a pick module with flow rack and try with Conveyor down the middle, which helps to increase productivity, can be zone picked, can be picked to light. And these are all things that have to be accomplished to survive in this new e-commerce world. Next slide. You have to learn the rules of the game, and then you have to play better than anyone else, Albert Einstein. And today, it's never more important. What we're dealing with today is we have to ship faster. We have to get it to the customer. And if the customer doesn't like it, we have to bring it back into the warehouse, which returns is now a whole new section of the warehouse that we have to deal with. So all of these things have to be examined. But if you do them correctly and you put automation in place, you can become very productive and very profitable. Increasing cash flow and loan options and tax incentives. Going to turn this over to Josh.
Thanks, John. So for those of you who aren't aware, there were certain provisions within the CARES Act that were very, very beneficial to the taxpayer. Some of those by way of loan program and some of those through tax incentives. So we're going to take a couple minutes and we're going to dive in to help you maximize really the cash flow potential here. So the most common at this point, many of you who are listening have applied and received funds through the PPP program, the Paycheck Protection Program. Hopefully, if you hadn't, you got in before the August 5th deadline. At that point in time, there was still about $130 billion remaining. Just as a refresher, remember this loan is eligible for forgiveness if you expend the money in the appropriate time frame. The original PPP loan agreements were for 8 weeks, and the SBA later modified the covered period to 24 weeks. And again, as I said before, these funds are eligible for complete or partial forgiveness as long as the money is spent appropriately. And there's certain metrics that you have to meet in terms of payroll versus non-payroll costs. And although this is an SBA program, you were able to apply for these loans through your local designated banks. The second one is the SBA Economic Injury Disaster Loan, or commonly referred to as the EIDL. These loans are still available, and businesses can apply for loans up to a max of $150,000. These are your traditional 30-year loans that for-profit businesses come at a 3.75% interest rate. You do apply for these loans through the SBA website directly, and these funds are used to help companies with operating payables. Um, the money could be used for payroll to the extent that you did not receive PPP money, again, which was also used for payroll. But a common misnomer is people believe that you can only apply for one of the loans. That's not true. If you did receive a PPP loan, you are still eligible to apply for an NIDA loan as well. And a newer program, which came by way of concern that the banks would not continue to lend during this time just because of the great amount of uncertainty that's out there, is the Main Street Lending Program. And there are 3 different loan options available under this program. And how you determine how much of a loan you're eligible for, it depends on the calculation of normalized EBITDA minus current and unused debt. This program, as well as I mentioned before, is an SBA program, and a lot of the banks are coming online, and you will be able to apply through them. So those are the loan options that are out there currently. Now we're going to touch on some of the tax incentives. So the first one is modifications for net operating losses. So pre-CARES Act, if you had net operating losses, you could not move them backwards. You were able to carry them forward, and you were limited as to how much you could use. So 80% of taxable income. Now, under the CARES Act, they say if you have losses that have arisen in tax years 2018, 2019, and 2020, you're able to take those losses and you can carry them back 5 years. So if you did have a period within that 5-year window for which the company made a lot of money, you paid a lot of tax, whether it be at the corporate level or the personal level, you have the ability to turn that tax into dollars back in your pocket. So for years 2021 and after, you can only carry forward, and you're allowed to use your net operating losses up to 100% of your taxable income, again, for 18, 19, or 20, and for 2021 and after, it goes back to the 80% limit. So these rules do apply to individuals, trusts, and estates as well. So think about who your shareholders are and understand that that option is available. The next one is with respect to modifications of limitation on business interests. So if you're a business that's heavily leveraged and you have not met the requirement for being able to deduct your business interest, you're now able to adjust up to 50% of your adjusted taxable income. Previously, it was only 30%. And another thing here too is, in addition, the taxpayer can elect to use their 2019 adjusted taxable income to calculate your 2020 limitation. And if there's any question as to how you calculate that adjusted taxable income, you take your taxable income plus your interest expense plus your depreciation plus your amortization. So again, if you're a business that carries a lot of debt, and maybe you weren't able to take advantage of the interest deduction, you now have increased your ability to create a lower taxable income going forward and use that money effectively. And then the third modification is with respect to a technical correction that was issued with respect to qualified improvement property, or QIP in our accounting lingo. So this is effective for taxpayer years beginning after 12/31/17. And again, this is on your qualified improvement property, and it takes that property from being eligible for depreciation on a 39-year life to 15-year life. And even more importantly is, as 15-year property, it's now eligible for bonus depreciation. So where previously you could not write this property off in year 1, you now have that ability. And just a definition of qualified improvement property is that it includes any improvement made by the taxpayer to a building's interior which is non-residential real property if such improvement was placed in service after the building itself was placed in service. However, three key things here. Improvements do not qualify if they're attributable to the enlargement of the building, any elevator or escalator, or the internal structural framework of the building. And just one final thought on this is making innovative investments in your business by spending on automation and enhancing your warehouse not only improves operations in the current environment, but you're setting yourself up for success in the future. So know what's available to you. And at this point, I'm going to pass it on to Bill, who's going to talk about another way to increase cash flow, and that's by turning your inventory into cash. Bill, take it away.
Thank you very much, Josh. Yeah, cash flow is the lifeblood of a business. So focusing on converting excess inventory back to cash will create liquidity, and it will certainly increase your profitability, and that's what we're going to discuss. So very quickly, we're going to talk about what is excess inventory, the trends. We're going to look at some metrics that are critical, look at its impact to the bottom line, resources for disposal of it, and later on, I'll be doing a real practical example for everybody to follow of a quick way to get as much money as fast as possible. It says excess inventory is inventory you don't need. It's excess dollars in working capital sitting on the floor. It's hidden treasure on the balance sheet, because if you convert it back to cash, that's a good thing. But on the other hand, if you don't convert it back into cash, it's toxic to the bottom line. Dead dollars sitting on shelves of floor, wasting space, producing no gross margin, no useful purpose. Next slide, please. In the past 5 years, systems and technology have gotten sharper. That means the tools are better. That means the amount of inventory you need based on these latest tools is less. So you need less inventory. On the other hand, the carrying costs of inventory, particularly as it relates to supply chain items, as well as individual carrying costs of your own warehouse, they've increased. And unless you're not using the latest technology, you could be sitting with, originally, before COVID, it was 20 to 35%. Now it's closer to 35% to 60% in dead dollars, dead working capital. Converting dead dollars into cash, big improvement to the bottom line. Easily corrected and no need for drastic, expensive changes. Let's talk metrics. Metrics is everything. When you're ever talking about an inventory system, we're going to discuss the 5 most critical metrics. This is real data. So the first one I want to talk about is inventory turns. And inventory turns measures the number of times your inventory turns over in a year. So here we have a company whose sales at cost divided by inventory is 3.5 times. So it's got sales at cost of $3.5 divided by inventory of $1 million. By the way, that you want the inventory to be an average. So if it's a seasonal business, you take a beginning of the year and mid-year and end of the year. A better way to look at that is really the reciprocal. Everybody talks turnover, but it's also important to talk in terms of weeks or months of inventory. And the equation for that is 52 times the dollars of inventory divided by sales at cost. So if I take that same data, that comes out to be 14.8 weeks of inventory. Now, why is that significant? Because the first thing I always ask is, what's your vendor lead time? So if you're sitting with a vendor lead time of 3 to 5 weeks and you're carrying 14.8 weeks of inventory, right away, I know you're sitting with a ton of excess inventory before we even look any further. And by the way, that calculation is an average. So if you've got 5,000 SKUs in your business, 2,500 are less than 14.8 weeks, and the other 2,500 are greater than 14 weeks. It follows the normal bell-shaped curve. So I like the reciprocal of turnover. It's easier to understand. We want to compare it to vendor lead times. The next important metric is customer service. People say they're in the customer service business, but they don't measure it. That means you're losing money. Always works out that way. There's a number of different definitions of customer service levels. This is a must to be measured on a monthly basis. You could have percent dollar demand satisfied on time, percent back orders, percent line items out of stock, lost sales, and another one that you could have that's very similar is percent fill rate on all the orders. But it's an indication of lost sales and disservice. And here's a very important principle. In every competitive environment that I have ever worked in, whoever has the highest real level of customer service when measured quantitatively always makes the most profit. So, and it also helps reduce inventories. Next slide. We talk a little bit about carrying cost of inventory. That's the cost of owning the inventory. And it's such items as floor space, utility handling, excessive material handling, shrinkage, obsolescence, insurance, and always use an opportunity cost. There's a slide at the end that you'll see, which is a practical example of how to calculate your inventory carrying costs. And there's two types. There's an incremental carrying cost and a total carrying cost. The incremental one does not consider floor space cost when you make small changes to the inventory level. It's a very critical factor. In most warehousing operations, it's a lot lower than retail. Retail is the highest floor space cost. So, inventory carrying cost could be 45 cents per dollar of inventory. And now we're going to talk about probably the most important metric, which is gross margin return on inventory. This is a return on assets approach to inventory management. And the equation for that is very simple. It's dollars of gross profit divided by dollars of inventory. Like I said, it's the single most important metric. And it's averaged over all SKUs. And when we do the reporting I'm about to show you, you measure it by each and every SKU, and then you sum it up and look for totals of all the SKUs. GMROI is the amount of gross profit that each dollar of inventory produces. And you want that number to be as high as possible. So let's take a look at Company X. He's got revenues of 10 million, gross profit percent of 35%. He's carrying 2.4 average inventory level with 12,000 SKUs. His GMROI is $1.46. That is very bad. Here's a good rule of thumb. Anything less than $1.75 for the entire business always suggests profitability and cash flow problems. Take a look at some well-known retail, publicly held companies. Party City, 1.64. That's horrible. They're a $2.3 million company. They're closing stores left and right. Every one of their stores looks like a stuffed sausage. Then you have Walmart, sort of the cream of the crop, $2.79. Target, $2.50. Costco, $1.91. All of this data was readily available off their company 10Ks. Next slide. So getting back to Company X with the GMROI of $1.46, we want to shoot for a GMROI of 2. And, that doesn't happen overnight. We've got to get rid of a lot of excess inventory. So a GMROI of 2 means that he's sitting with $650,000, which is 27% in excess inventory. This is real data from a real experience. We were able to recover 80% of that at cost. And that happened in 6 months. So that brought in $520,000. But then you got the carrying cost savings, which happens every single year that you keep the inventory tight. And that carrying cost was 25 cents per dollar of inventory times the total excess inventory of 650,000, which is $162,000 each year for the next 3 years, for a total of $487,000. So over 3 years, the total cash flow improvement was up $1 million. Plus, if you fix customer service levels and get in stock on out-of-stock items, that will increase gross margin, which helps get the GMROI up even faster by reducing lost sales. And just as important, if you're looking for a big tax credit for a privately held company, this is the documentation you want to use. And, privately held companies always want to lose inventory, and publicly held companies always want to find inventory. Next slide, please. This is traditional ways of getting rid of excess inventory: return to vendor, liquidators, barter, creative use of the internet, specialized website. It's such a serious problem. I've gone out of my way. I developed a relationship with a series of resellers with 30 people in the Near East. These resellers are not liquidators. They're bringing a higher gross margin. So it's sort of like one-stop shopping with me. But, I had to find a way to help people get rid of that inventory besides just liquidators. On a monthly basis, you want to have a sharp system, you must track the following. And this is not negotiable. These are all the critical metrics: total weeks of inventory, excess inventory, fill rate, lost sales, GMROI, and carrying costs. If you don't see those carrying costs going down on a periodic examination, something's not right. Next slide, please. And now I'm going to turn it over to Josh, who's going to give us some more valuable information.
Thanks, Bill. So we're going to take a look at a distribution business that we have all had a hand in helping. The company, although operating for many, many years, needed help with really repositioning the business. The company sells its product primarily into retail, and it was spending significant dollars on overhead costs and was constantly sitting on high levels of SKUs. The guys are going to discuss in further detail how they were able to help the company and recommendations to help the company. I'm going to turn it over to Sandy.
Thanks, Josh. This was a customer of mine, and thankfully I was able to bring Josh in to provide tremendous value in accounting services. When I saw what their needs were, as they were already being challenged prior to the pandemic to maintain profitability in a changing world where their business was shifting from retail to e-commerce. All of that was exacerbated, forcing them to reduce their total facility space in half, from 100,000 square feet to 50,000 square feet. Simultaneously, they had to address, redesigning. How are they going to store the inventory that they currently had? How are they going to make up for lost stocks? And how are they going to maintain profitability in this now predominant e-commerce world? So to do that, there's a lot involved. You're looking at what are they doing today in their ERP system? How well are they tracking their inventory? What are they using? What are they not using? And then also looking at, okay, now what are the capabilities that we have to redesign this facility? And that's where I brought John in. John, why don't you take it from there? Thank
you, Sandy. One of the most important things about a warehouse is how we design it. And our goal here our mission was that they cut 50,000 square feet. So we had to do it in half the space, but the business had changed to e-commerce. So we designed a pick module where we could get the SKUs in there. And Bill will talk a little bit later about how we reduced the inventory. But we built a pick module where we now know that 55% of all pickers spend their time serpentining through aisles trying to find products. What we've done is we've turn around now and by putting a tri-width conveyor system down the middle of the pick module and having the SKUs in flow rack, the pickers pick in a zone or a pass and pick type method, so they don't have to walk or serpentine through the whole warehouse. That increased the efficiency for this customer, and what it did was it helped. And we also provided the proper slotting, which Sandy knows about, and he has ways to do that through WMS. And what we've done is, in a lot of cases, we created a warehouse within the warehouse, and we broke out the e-commerce business and put it all through the pick module. And then the old traditional business, which continues to get less and less case shipping and pallet shipping, has been put into the other parts of the warehouse. So when we redesigned this, we took 50,000 square feet less, but we made it more efficient. Next slide. I'm going to turn it over now to Bill, who's going to talk about the inventory, which was very important in this project because we needed to make sure that they didn't have too much of the products that they needed. Bill?
Thank you, John. Let's just take, this is a list of what is the result of the diagnostic reports that I use. What happens is I get people to email me some data out of their ERP, and I use it to produce a whole series of reports from the same database. But the key items, let's just identify what they are. I'll be able to identify, with this data, I identify excess inventory by individual SKU. I can identify the SKUs that don't contribute significant gross profit and identify the SKUs that lower GMROI, which is the gross margin return on inventory. The rest you can read on your own, but what I'd like to point out about this is that if you're ever involved in a merger or acquisition type analysis, no matter what side of the table you're sitting on, running these type of due diligence reports is critical in terms of improving your profitability from the transaction. If you're selling inventory, you'd want to clean up the blemishes. If you're buying inventory, you'd want to find out just what the inventory aging report shows. Yeah, so it could be up to 7 different reports. And one of the other really interesting things, it has never happened. There has never been a case where when I run these reports, I don't find one item that helps get immediate gross margin dollars back. I had an experience where ran the reports and we were looking, among other things, at the individual gross profit percent of all the items, and the company was shocked to find out there was a substantial number of SKUs that were way out of line in terms of gross profit percent. They improved that, they corrected it. It was a mistake in their billing system. So that's what the report found. Next slide. All right, this is an actual example of it's report number, it's actually report number 4 out of the 7 reports, and it creates immediate liquidity. So here we have 5,000 SKUs, 3.6 million in inventory, and we separate the inventory by individual SKU, by class, by section, by category. So we're going to produce this, what's called an inventory aging report. And what I've done here is I'm giving you the total from the bottom line of that report. So on the left-hand side, you see that this company had 3.6 million in inventory. And then if sales continued at their current rate, after 6 months, they'd still be left with 42% of their inventory. After 12 months, 33%. 18 months, 28%. After 60 months, almost 20% of their inventory. So you could visualize that if you broke this down into various categories, it immediately establishes priorities for converting that excess inventory back into cash. Next slide, please. Same data. Now I'm going to break it out into what's called the ABCs. Actually, you end up with more categories, never more than 5, but this is simple to understand. We're going to break the excess inventory into 3 groups: surplus, obsolete, and slow moving. The surplus are the A's, and they're the ones with the highest, with where you can get back, they're the fast movers, so you can get back their cash faster than any kind of government program. Obsolete, the exact opposite. Slow moving, somewhere in between. What's important is whatever you identify as surplus, which is the A's, you can expect 100% of your gross profit, and you do that. Maybe you have to market some of the excess out, but tightening up the inventory reordering rules generally gets immediate results. Take a look at the bottom chart. A's, 6.12 million at cost. Inventory, 2.34. Inventory turns, 2.6, which is 4.6 months of inventory with a GMROI of 2.1. So you see the total inventory broken down by the ABC groups. Next slide. What that meant was if you had 6.12 sales at cost for all the A's, and the actual months was 4.6, but the target of what the new reordering strategy would produce is 3.5, that means we're going to get rid of 1.1 months of inventory. Well, 1 month was 510,000. 1.1 months is 561,000 of fast-moving items. Expect the full gross profit. 16% of the inventory was excess A's. Focusing on A's, which was the top 20% of items, it raises the GMROI from 1.6 to 1.9, which was a 19% increase. And it's those items alone saved in carrying costs $112,000 a year. Next. Let's look at the bottom of the curves. The bottom of the curve showed that 30% of the worst SKUs represented only a tenth of 1% of sales, but 13% of the inventory, which was a tenth of percent of the gross profit. Those are items that did less than $100 a year, yet their top item was $150,000 a year, with over 50% of the SKUs with a GMROI of less than 1.5. All of these reports are driven by metrics. And when you have screwed up data, all the errors either go to the front of the report or the bottom of the report. And there's no way, in any way, shape, or form, to clean up a database faster than the output from these reports. Next slide. I wanted to show you an example of carrying cost, because I said measuring carrying cost is important. Floor space, excessive material handling, insurance, taxes, obsolescence, shrinkage, which is looking to get higher. Obsolescence, especially because of COVID, is increasing. Interest. When I prepared this slide, I should have used a higher opportunity cost. In today's world, the opportunity cost of capital can never be less than 15%. And Sandy discussed all the things that your company could invest in, and one of the ways you pay for it is by getting rid of excess inventory. So you always want to have the cost of capital, not the opportunity cost of capital, not the cost of capital. Sorry about that. Shrinkage, breakage, definitely becoming a serious problem where you're dealing with more valuable items. This is interesting. If you've got stuff sitting in your inventory and your carrying cost is close to a third, guess what? You paid for it twice. Think about that. Next. And now I'd like to turn it over to Josh.
Thanks, Bill. So first of all, I want to thank all my panelists this afternoon for really pitching in just a lot of great information for everybody to digest and think about. But I want to give the guys an opportunity for one last final thought. So Sandy, I'm going to pass it to you first.
So thank you so much. And, the first thing that comes to mind is a line I've been using for years. It's not about the technology, it's about managing change. And that's what's needed to survive and thrive in the world we live in today. I thought, Josh, you gave a great summary of ways to get capital and Bill just gave, clear, quantifiable ways to take inventory and turn that into cash. My thought is it's more than that. It's the ripples of that, because this excess inventory takes up space, valuable real estate that's clogging aisles and docks today. It increases the labor and therefore the costs associated with managing that. And as John shared earlier, it's the labor and the time, the travel costs that we look to really address and do much more efficiently and much less expensively, so that all those factors drive money to the bottom line. And if you eliminate this excess inventory, so many companies are out there looking to lease space. They're not looking to buy additional space, which is scarce and costly. But this way you're not having to do that by looking at what can you do to free up space or to use it much more efficiently. So John, that's the handoff to you.
Sandy, I want to thank Josh and Sachs for the opportunity here today. As I said before, just only 4 to 6 months ago, we did another webinar like this, and we talked about e-commerce and its growth. And now we definitely know that e-commerce is not only here to stay, it's a supernova, as Sandy might say, and it's exploded. And we're definitely living in unprecedented times. The changes that have come about because of the COVID virus and e-commerce have never been seen before in the supply chain. Each one of us here represents a segment of the industry that I think can help your company and make the changes that will increase your productivity and your bottom line. I think if you take a combination of everything that was said here by all of us and implement those things, it's really going to help you. And I hope it's provided you an outline to help your company survive, grow, and thrive through these unprecedented times. So thank you, everyone, and I'm going to hand it off to Bill.
What I thought I'd like to mention is both sides of the coin. Many times I get asked, you always have to have goals. And what is the single most important goal when you get involved with an inventory management system, and particularly getting rid of excess inventory? And the answer is GMROI. You must focus on all the activities that will make GMROI no less than 2.0. On the opposite coin, what's the biggest mistake that most companies are currently making with regards to inventory management? The first one is a failure to measure and believe in the carrying cost of inventory, and even worse, a failure to quantitatively measure customer service. Customer service is so measuring quantitatively customer service is so important because it has a direct relationship on the amount of gross profit dollars you're bringing in. So you can make GMROI better and the numerator better by getting rid of lost sales, and you can make the denominator better, the inventory, by getting rid of excess inventory.
Thanks, Bill. And I want to thank everybody for participating. For all of you listening, everyone's contact information can be found on this page. And I just want to leave you with one thought. It's simple, but I think it's very effective. And I think it's been really driven home today. And that's that knowledge is power, right? When you live in the business and you're so focused on the detail, sometimes you're really blinded by what is around you. And being able to understand what capabilities are out there and available to you is very, very powerful. And having the right advisory team with folks such as the people who have presented today is really your ultimate key to success. So I want to thank everybody for listening. If you have any additional questions or comments, please email them to covid19@sacsllp.com. Be healthy, be safe. Until next time, thanks again for listening.